Let's talk some earnings. We got the banks doing all right today, a better batch it seems. Joining us to talk reports going into the second season, Greg Halter is the Director of Research at Carnegie Investment Counsel. Greg, thanks for being here this afternoon. What's top of your mind going into the calendar for this earnings season? Is it the big tech stuff that's got to justify valuations, or is it now kind of like the cyclical stuff that suddenly everybody's hopeful about?
It's probably all of the above. We focus on about 80 companies here at Carnegie for our portfolios, and they run the gamut of large cap to mid, maybe some small caps. But we're certainly looking at how things will play out in the consumer area relative to GLP-1 drugs and what kind of impact that'll have. Financials, certainly hear from JP Morgan. Always good to hear what Jamie Dimon has to say about the economy.
What did you think about that? Let's start there as the economic outlook now becomes particularly interesting with the market trying to rotate into this stuff. Did you think that the banks were encouraging?
Their report I thought was good. They seem to always want to talk down their figures, if you will, or the outlook. And I know he's got concerns about the high debt levels in the U.S. and so forth and so on, but they keep chugging along. We think JP Morgan is best in class in terms of financials. It's been harder to find a better company than JP has been for a number of years. Very good returns. Just an excellent record, and they span not just the U.S., but the globe in their business operations.
Does it look like the economy from a lending perspective is sustainable right now, or do the banks tell us that they need some help?
I don't know if they need help. I think there's been kind of a sea change in the last 5 to 10 years in the banks and lending. A lot of the lending is not coming from the banks. It's the non-bank banks. You know, the Fed has, I think, consciously moved some of this lending off of the bank's balance sheets so you don't have the capital at risk in the system and the whole FDIC insurance fund and so forth. So you almost have to look not just at the banks, but many of the other lenders that are out there. And you've got, of course, got a huge private equity market as well that's functioning and is massive in terms of trillions of dollars that they have available to lend.
Thinking about what else is on the calendar, we get Amazon with Prime Day. Not an earnings event, but I think this becomes more of a story for them lately with the stock trading so well alongside Costco, Walmart. I feel the retail margin expansion there too has been an underappreciated story. How does that kind of fit into catalysts for the market?
Well, obviously, it's a large company and has a great sway. You certainly will hear about the consumer in what they're doing. And I believe, well, this is their 10th Prime Day over the next 2 days, tomorrow and Wednesday. And I think the expectations are close to $8 billion in revenues, with $6 billion of that being incremental, compared to $400 million the first time they did this in 2015. So this is big. And I don't really think that the Prime Day is sure it's important, but what's really as important is what they can do with how they bring this all together into their ecosystem between the advertising, the streaming service. They're the 4th largest now. If they can add more Prime members, and they've got about 325 million, this is all great material to sell ads. So Amazon is not just one business anymore. And of course, you got the AWS business on top of it. The stock has done very well after having a rough patch there for a while. We continue to like Amazon. They really seem to be hitting their stride right now.
All right. You like Amazon. JP Morgan, we mentioned a few other names I just want to hit real quick that stand out to me as kind of unique. I don't hear very often. I mentioned Costco, Walmart. You do like those. Casey General Store, we've hit that one in our Overlooked segment a few times, so you like that too. Cintas and waste disposal companies. So where do those fit in? You call Cintas, which makes uniforms and other stuff, a must-own stock.
It's definitely a must own for the long term. I'm not sure I'd be chasing it right here at the current valuation levels. But this is a company that does a pretty mundane business. They rent uniforms and they do floor mats and first aid and safety. But the key here is that they have been in front of their competitors who may want to sell because they're family businesses for years, if not decades. And Cintas becomes an entity that these small businesses will sell to. And just think about if you have a route with 10 potential customers, Cintas has 5, and you're going to add 1 or 2 more to that same route. You're driving by it. You're already making the drive. You're already expending the fuel. If you can stop in 1 or 2 more on each one of these delivery routes, it's all about route density and the whole flywheel effect. And Cintas has just tremendous free cash flow, tremendous dividend record. They reduced the share count by 40% over the last 15 years or so. It's just a well-managed, well-oiled machine. And as they are able to buy some of these, and they've done 3 in the last 18 months or so of these smaller businesses, that just adds to their scale.
Interesting. Yeah, I hadn't realized that they were rolling up like companies like that. Greg, good stuff. Appreciate the insight into the stocks.
Thank you very much.
Yeah, nice convo. Greg Halter, Director of Research at Carnegie Investment Counsel.